Recent volatility across global financial markets has once again highlighted the interconnectedness of geopolitical tensions and asset prices. As the United States Senate navigated contentious budget negotiations, the looming threat of a government shutdown sent ripples through both traditional and digital asset classes. This event, coupled with assertive rhetoric on trade tariffs from the White House and the strategic deployment of American warships to the Middle East, created a potent mix of uncertainty. The immediate effect was a sharp downturn in risk-on assets, with the cryptocurrency market experiencing a particularly acute reaction. Within a matter of hours, the total cryptocurrency market capitalization fell by approximately $100 billion, demonstrating the sector's sensitivity to macroeconomic sentiment. This period of heightened fear offers a valuable lens through which to examine a more fundamental and ongoing process within the digital asset space, a significant shift in capital flows and the beginning of a market-wide filtration phase. The topic of this analysis is the ongoing transition within the cryptocurrency market, specifically focusing on the movement of capital and the structural changes it implies. This is not a narrative about the death of crypto, but rather an examination of a maturation process. This subject is critical in the current global system because it reflects a broader revaluation of risk and value across all financial sectors. For years, the cryptocurrency market was characterized by speculative fervor and explosive, often disconnected growth. Now, as the global economic landscape becomes more complex and uncertain, the factors driving investment in digital assets are evolving. The persistence of this transition attracts the attention of investors and institutions because it signals a move away from purely speculative momentum and toward tangible utility, regulatory integration, and sustainable ecosystem development. Understanding this shift is essential for comprehending not just the future of digital assets, but also the changing nature of capital allocation in an increasingly digitized and interconnected world. The core idea of this analysis is that the cryptocurrency market is undergoing a structural transition, shifting from a phase of habeta, speculative growth, to one focused on practical application and infrastructure development. This transition is not a sign of the industry's demise, but rather a filtering process where capital becomes more discerning. Historically, the crypto market's growth has been fueled by retail enthusiasm and venture capital chasing exponential returns, often with limited regard for fundamental value or sustainable business models. This created a cycle of dramatic booms and busts, where market sentiment was the primary driver of capital flows. The institutional context has been one of regulatory ambiguity and a high tolerance for risk. However, the current macroeconomic environment, characterized by higher interest rates and geopolitical instability, has fundamentally altered the risk-reward calculation for investors. Capital is no longer flowing indiscriminately into any project with a compelling white paper. Instead, it is seeking assets with clearer value propositions and more robust foundations. This system operates under real-world conditions by exhibiting a clear divergence in asset performance and development focus. While the overall market capitalization has seen declines, specific sectors within the crypto ecosystem are demonstrating resilience and attracting significant investment. This bifurcation is a classic sign of a maturing market. For example, the narrative of explosive, thousand-fold returns on obscure altcoins is being replaced by a focus on building the foundational layers of a new financial system. The speculative capital that once chased these higher-risk bets is now either exiting the market in search of safer havens or rotating into crypto sectors with more defensible long-term value. This filtering mechanism is separating projects based on their ability to generate real-world utility, integrate with existing financial systems, and navigate an evolving regulatory landscape. The market is effectively being stress-tested, and only the projects with genuine substance are proving capable of retaining and attracting capital in this new, more demanding environment. A real-world operating scenario of this capital filtration can be observed in the market's response to recent macroeconomic pressures. When concerns over a potential United States government shutdown and escalating geopolitical tensions in the Middle East intensified, the immediate market response was a flight to safety. The crypto fear and greed index plummeted to a reading of 20 out of 100, indicating a sentiment of extreme fear. This triggered a cascade of liquidations, particularly for traders using high leverage, as Bitcoin and Ethereum saw sharp price drops. During this same period, traditional safe haven assets behaved as expected. Gold prices recorded a nearly 15% increase over the past year, and silver futures surged by an astonishing 229%. Concurrently, the S&P 500 index maintained a trajectory of steady growth, suggesting that institutional capital was prioritizing stability in proven asset classes. Over the high volatility of the crypto market, this pattern of capital flow, moving from higher-risk digital assets to traditional havens like precious metals and blue-chip equities, illustrates the cyclical nature of risk appetite. It is not an exodus, but a temporary reallocation based on the prevailing macroeconomic climate. Experts widely see this as a cyclical shift, anticipating that as macroeconomic uncertainties eventually subside, capital will likely flow back into riskier asset classes, including a more discerning and filtered cryptocurrency market. Despite the short-term volatility and the observable shift of capital towards safer assets, numerous sectors within the cryptocurrency ecosystem are not just surviving but actively thriving. This resilience is the strongest indicator of the market's transition to a more realistic and sustainable phase of development. One of the most significant areas of growth is in the tokenization of real-world assets, or RWAs. This sector bridges the gap between traditional finance and the decentralized world by representing physical or traditional financial assets, like real estate or treasury bonds, as tokens on a blockchain. Projects like Ondo Finance, which is tokenizing United States Treasury bonds, and initiatives from major financial players like BlackRock, exploring tokenized money market funds, demonstrate a powerful institutional interest in leveraging blockchain technology for efficiency and accessibility. This trend is not about creating a new, speculative asset class, but about upgrading the infrastructure of the existing financial system. Simultaneously, there is a concerted effort to establish Bitcoin not just as a speculative store of value, but as a politically accepted and integrated financial asset. The ongoing development around Bitcoin staking and layer 2 solutions aims to increase its utility and scalability, making it a more functional component of the broader financial landscape. This aligns with a strategic push to gain regulatory clarity and acceptance, transforming Bitcoin's perception from a fringe asset to a legitimate part of institutional portfolios. Furthermore, the challenge of interoperability, enabling seamless communication and asset transfer between different blockchains, is being addressed with increasingly practical solutions. Projects like the Interblockchain Communication Protocol, or IBC, are making the vision of a connected Internet of blockchains a reality. This is crucial for avoiding the fragmented, siloed ecosystem of the past and building a more cohesive and efficient digital economy. Stablecoins continue to solidify their role as essential payment infrastructure, facilitating billions of dollars in daily transactions and serving as a critical link between the fiat and crypto worlds. Finally, the emergence of on-chain commodity trading platforms, which aim to bring assets like oil and gas onto the blockchain, points to the expanding scope of tokenization and the industry's ambition to touch every corner of the global economy. The current market dynamics, therefore, should not be misconstrued as the end of the cryptocurrency market, but rather as the beginning of a crucial filtering phase. This is a period of consolidation and maturation where the speculative froth is being skimmed off, revealing the underlying substance. We are witnessing a clear divergence in the market's human capital. All part-time developers and opportunistic participants who entered during the last bull run may be leaving. The core development teams and the most committed builders are doubling down. These are the individuals and projects with a long-term vision, and they continue to attract significant venture capital investment, albeit under more stringent due diligence. This signals a shift in innovation itself, moving away from purely disruptive 0-1 breakthroughs and toward more incremental foundational improvements. The goal is no longer just to break things, but to build lasting and integrated systems. The flow of capital toward traditional assets is a rational, temporary response to macroeconomic uncertainty. As these external pressures eventually shift, that capital is poised to return. However, it will return to a different market, one that has been tested, filtered, and fortified. This process, while painful for speculators in the short term, is ultimately healthy for the long-term viability of the industry. It will strengthen the projects with solid foundations, realistic use cases, and the resilience to build through market cycles, paving the way for a more sustainable and integrated future for digital assets.